Friday. Brian Manning here with your weekly update. Let's get right to it. So Monday of this week, quiet news day, not much to report there. Tuesday, CoreLogic gave us some data on delinquencies. So delinquencies we look at are people that are 90 days or more behind on their mortgage payments. So year over year, delinquencies are at an amount of 2.1% of people that have mortgages on their homes. This is down from 2.7% last year. So still continuing to see decrease in delinquencies. Really the magical elixir here is appreciation, home values going up, economy getting a sure footing, and certainly helping out with delinquencies. Wednesday this week was Fed Day. But before we get to that, let's talk a little bit about other data on Wednesday. First, we got the CPI. CPI is a consumer price index. This is a gauge of inflation that we really like to look at. And CPI was down from 2.2% to 1.9%. And a lot of bond traders would think that if the inflation is going down on its own, potentially don't raise interest rates to the Federal Reserve because inflation is kind of taking care of itself. So interesting to have a thought of not wanting to raise rates there. We also got mortgage applications. Mortgage applications year over year on purchase transactions up 8%. Now let's talk about the Fed. Federal Reserve hiked rates 0.25%. Widely anticipated, not a big deal. Everyone really expected it. What was really the most talked about on our side is the tapering off of their balance sheet. So last Federal Reserve meeting, Federal Reserve talked about finally getting off of their 4.4 trillion or so balance sheet that they own right now of treasuries and mortgage-backed securities. Of that, 1.8 trillion is mortgage-backed securities. So right now, Federal Reserve is reinvesting $30 billion a month into buying mortgage-backed securities. What they're going to do is start this tapering process, and they're when they implement it, they're going to reduce their bond buying by $4 billion. Then every 3 months, they're going to continue to reduce by another $4 billion. Overall, they're going to reduce a total of $20 billion, and that's going to leave them at buying $10 billion a month in mortgage-backed securities. They are the largest buyer of mortgage-backed securities. The cash that they've been infusing into these bonds has been holding interest rates down. Absolutely, no doubt, this will cause mortgage rates to go up over time. It's going to be a slow, gradual process, but we will see mortgage rates go up over time because of this. Today we got housing starts. Housing starts, they're down 5.5%. Not really a huge concern yet. This is all based on new construction, which makes up 10% of all transactions in the U.S. You know, ultimately builders are having trouble finding land. They're having troubles finding laborers. So not a concern yet. This is the third month in a row. We'll have to watch this. And if it continues to become a trend, then we'll probably be more concerned about it at that point in time. I'm around all weekend. If you have any questions, let me know. I'd love to be part of your business, help you out any way we can. We have a couple classes coming up, 4 in particular. One at First American Title is our next one with Alyssa. We have one at Barra, one at Lar, another one at Colorado Landmark, and also have our first summer happy hour coming up Thursday, June 29th, West End Tavern. Super excited to be there. Look out for an invite as well. Happy Friday. Have a great day.